All three major indexes bouncing back this morning as investors digest strong labor market data that will play into expectations for interest rate cuts. While we have seen pressure on US stocks in the first week of 2024, our next guest says there's still reasons to be bullish. Let's bring him in. Ryan Detrick, Carson Group Chief Market Strategist. Good to have you on the show here. So why so bullish after the week that was?
Yeah, we might have the first green day of the year today, so there's something to celebrate a little bit. But listen, I know a lot of people talked about the end of the year rally that was really strong, but then we didn't gain during the Santa Claus rally. Like the last 5 days of the year and the first 2 days of this year usually are higher, and they weren't higher this time. And there's a ton of ways we can look at this. I think I'll put it like this. We're in the midst of a 9-week win streak on the S&P 500. We think stocks were simply due for a well-deserved break. It's not like we're selling off massively here. I know tech's underperformed a little bit to kick this year off because of those Apple downgrades. We can get into some of the more of the reasons. I'll put it this way, though. A year ago, we didn't see a recession. We still do not see a recession. When you don't have a recession with likely record earnings, with productivity coming back, look at today's jobs number, we get into all this stuff, but it just still makes sense to us that the path of least resistance, at least for stocks, is still higher.
So walk us through that base case. Obviously, the Mag 7 really led the charge. A lot of people said, it was AI fueled. Coming into 2024, investors really want to see that where the rubber meets the road in terms of use cases there. But then, when you look at how the Mag 7 have performed so far, some broadening out of the rally, but are you as convinced at the moment, given where valuations are?
Yeah, we're more neutral, Mag 7 technology in general. We were more neutral all of last year. Trust me, I wish we were more overweight, the large cap tech names, but we just still see a little higher valuations. One of our big themes, though, really started in the middle of last year, was broadening out. We liked small and mid caps the second half of last year. Now, believe me, for about 3 or 4 months, that wasn't so fun. Now that the Fed is clearly saying we're probably done, the market's looking at interest rate or looking at cuts coming, we think small caps and mid caps are going to do really well. That broadening out theme. And here's something to think about. The Russel 2, right? The Russel 2 just had one of its largest 2-month gains ever, like over 20% the last 2 months last year. What does that mean? We took a look at the 10 best 2-month periods ever. Keep this really simple. 1 year later, the Russel 2, when you have a month, 2 months like we just did, has been higher 9 out of 10 times, up 27% on average a year later. Put a bow on this. That strength we saw to end last year to us is likely the sign that this broadening out, this strength is real, and small and mid caps and probably cyclicals as well will do better, taking the baton from the large cap tech, which obviously did so well last year.
So Ryan, what's going to be the catalyst then that really broadens out this rally?
Yeah, well, I think it's happening right now. And it is the realization that inflation is coming back down, that the Fed is likely done. Also, so we know those things. Those things are out there. One that maybe is not talked about as much is productivity. The last time our country had really strong productivity was in the mid-90s. And we've seen 2 quarters in a row of good productivity. What does that mean? We hired, 5 million people 2 years ago, like another 2.5 to 3 million people last year. People aren't jumping around from their jobs like they once were. So they're kind of happy where they are. We think our country is about to have a major surge in productivity, not even to mention, the AI and some of those other benefits that could be there. What does that mean? Well, in the mid-90s, you had higher productivity. Greenspan saw it. He cut. There's a cap on inflation. Oh, and by the way, wages stayed high. I mean, that's a pretty perfect scenario. If we can see that again, I'll be very clear. We think there's a chance, though, that can be the case. So productivity is a big key to us this year. If it stays stronger than people think, there could be a really good scenario where inflation is not a worry, wages are higher, and the Fed can cut. So that's how we see things playing out probably.
So then in this ideal situation, when you have everything potentially rallying here, what are you steering clear of? And what are some of the risks that you're keeping an eye on?
Yeah, absolutely. Again, we're overweight the cyclical names, right? I talked about industrials, financials, more even weight technology. What we're underweight, at least, is some of the defensive areas. Honestly, you want to see utilities lagging. You want to see staples lagging. If that changes, that could be the market's message of some type of a warning. So we're underweight there. Also fixed income. We came into last year very, very short duration bonds because we thought interest rates would go higher. We expected a better economy actually last year. So we thought that might hurt bonds a little bit. Now there's some opportunity clearly with fixed income now, but we're still underweight bonds right here. And we actually have a little bit of a sliver of gold in some of our tactical models. By no means are we like end of worlders or, gold bugs. But hey, we think gold could actually do pretty well this year as well. So that's kind of how we are. But we would not avoid, that's a strong way to put it, be underweight again, fixed income and some of the more defensive areas.
And Ryan, you didn't see recession last year. You're not predicting it this year either. What is it that's giving you so much confidence? What are some of the data points that you'll be looking for between now and when perhaps you see the Fed starting to pivot?
Yeah, a great question there. I mean, just earnings. I mean, listen, let's see what happens. Earnings season is going to start soon. We're looking at probably 12% S&P 500 earnings growth this year. We really think it could be a little bit stronger as the global economy comes back. Look what happened last year, right? China clearly was kind of a headwind for the global economy. Now, that we're not warm and fuzzy China, I want to be very clear. But again, the U.S. is going to lead, but there are some parts that are coming back. Also, hey, the consumer was the all-star last year. We're not seeing any breaks in the consumer, any cracks in the consumer. But manufacturing and housing, we're kind of headwinds last year. We're starting to see manufacturing show signs of improvement. Look what happened with interest rates, some of the housing data. So again, those are kind of some of the things that we see that suggest to us, led by a strong consumer, that the odds of a recession are just still quite slim in 2024 in our view.
So right, so just to clarify, the recession, will it be the consumer that makes or breaks it, or will it be something else?
Yeah, it'll probably be the consumer. That's a great point. I mean, the consumer makes up, 70% of GDP. So I think, it probably would be the consumer when that eventually takes place. But I'll tell you, look at real wages, right? Everyone knows, just the discussions you had before I came on. Inflation. We get it. I mean, it's still out there, but inflation has come back an awfully lot, especially when you take out shelter. Nonetheless, when you look at real wages and real incomes and real net wealth, I mean, it is what it is. Those things are near all-time highs. So people don't like paying more for things, but in a lot of cases, people are worth a lot more and they're probably making a lot more. So that's kind of one of the big drivers that is not a problem for the consumer as of now, at least.
And that's certainly important context when we think of, especially when we look at things like consumer sentiment. So appreciate you joining us. Ryan Detrick, Carson Group Chief Market Strategist. Always good to have you on. Have a great weekend.
Thank you. Happy New Year's. Thank you.